Okay, and welcome to another episode of Beating Alpha. This is episode 88, and we have a very special guest on. Very excited to have him on, and we're going to cover a lot of great topics. So if you're looking for those real estate tips, nuggets, strategies, this is going to be a show for you. So Ismael Rey Reyes, he's been actively investing in residential real estate since 2005 and has focused exclusively on multifamily since 2016. He has led MI Real Estate in investing in 10 multifamily properties totaling 382 units and valued at over $24 million. Ray also provides independent consulting to multifamily investors and is the author of a number on one real estate new release on Amazon. So that's titled Bluff, the bottom line up front about passively investing in multifamily properties. Sorry about that. But listen, all of that great information is going to be included in the links down below. So make sure go and check it out, mirealestate.us. That's the website. And of course, connect with Ismael on social media. But first of all, I just want to thank you for being today on the show.
Oh, it's absolutely my pleasure. Thanks for having me.
That's no problem. Happy to connect. Listen, so first things first, right? So 2005, you've been actively investing in residential real estate since 2005. So can you talk about your personal journey? I mean, how did you discover the real estate investing before the 2005?
Yeah, no, great question. And it is kind of my why, right? So I'm the kid that growing up liked Monopoly as it's the favorite game. You know, I enjoyed it just made sense to me in a lot of ways. You know, you kind of go through the game, you go around in a circle, but depending on what you do as you go around, the idea is you acquire properties, you acquire real assets, and then they start paying you regardless of whether you go around or not. And so it just kind of stuck with me. It just took a while as I grew up, went to college, and then I joined the service. So it took a bit to kind of get to where I wanted to go. I had some other passions that I really wanted to also take care of, military being one of them. But all along, I knew I kind of wanted to be where I'm at, and then certainly on this continued journey.
Got it. So again, digging in deeper, because I like the why thing still. I mean, it's a big part of your journey, continuing, to $24 million, assets under management. So who gave you that direction, like that you have to go and follow the real estate path?
Yeah, I mean, I think, like a lot of us, when we start reading, we start looking for value. We read some key books, and Rich Dad, Poor Dad was an eye-opening experience for me. You know, I was going to college. I had some notions about real estate, but when you read a book like that, it kind of starts putting things in perspective. The whole notion of cash flow, right? Because I mean, a lot of people work, and their goal is to just work long enough and hard enough to be retired. And it's like, well, what's the fun in that? And so you start looking for other options. And so that was kind of what led me there. I would say that, I started out doing single family. As I started finishing my military career, it was very apparent that it was just very hard to kind of scale to what I needed once I left the military. I had options like all of us. After a long career, a lot of us in the military just go ahead and do contract work, doing kind of the same kind of things we've been doing, but you're a contractor, and that was one path for me. But I had this other thing that I really wanted to do, and so in order to get there, I had my basic needs for my family met. But in order to really create generational wealth, I needed to come up with scale. And the way that it became apparent that I could do so is using the same sort of methodology of single family, but scaling that up to multifamily, where you could acquire a lot more and just kind of get that benefit of the scale. It was just you get to a point where you have to figure it out. And when it became, in my mind, something that done. That I use is real estate syndications, but that vehicle allowed me to get beyond having only money to, to buy single family into a place where you and I and others could get together and really maximize and buy bigger assets. And that's where, some of these benefits come in, because you go through that process of the acquisition, but at the end of it, you don't have one home, you have, depending on what you buy, up to 100, 200, 300 units. And that's just a mind-boggling difference.
Yeah. Okay. So again, as I mentioned before, one of your passions was serving in the military. So again, like, it's a great thing to do for yourself, for your own country. So, even though I'm not from States, thank you for your service.
Thank you.
And again, can you talk about how is that service, how is your time being in military help you to succeed in real estate business?
I think part of it, and this goes to most militaries. I've had a chance to serve with many different militaries from different countries, and part of what they teach you and what they grain in you is this notion of you can do it, right? It's like there's a lot of naysayers out there. A lot of people grow up in this, what I like to call this crab mentality, which is, everybody's kind of stuck in the barrel, and then whoever tries to get out, everyone else kind of just yanks them back and says, hey, that's stupid, that you can't do that, and kind of brings them back to that very low level norm, which shouldn't be the norm, but it happens to be. But they teach you to kind of go beyond that, and you go through a phase where you really believe in yourself and able to accomplish. It's eye-opening how much more you're able to accomplish than you thought you could. And there's many examples of that for different people. I mean, some people it's, can you climb up that 150-foot ladder? If you're afraid of heights, get around it and come back down on the other side. That in and of itself is something that could, for some people, it's just earth-shattering. So there's experiences like that I think help military members. But it's not just military members. I think people just have to believe in themselves. And part of my journey here, what I want to do is show others that it can be done. This is not a difficult thing. It's very similar, like I said, to buying single family. There's certainly some differences, but you just have to believe in yourself. And that's number one.
Beautiful. So, okay. So talking about your first, experience in residential real estate, again, you bought your first deal, 2005. So that was not long ago, since, like 2008 happened, the crisis, the recession. So can you talk about your experience, your transition into, this first investment? Can you talk about your first deal? I'm sure you still remember some parts of it. And
Yeah.
Can you just share it? What did it take for you to find that deal, close that deal? And how did you know that it's a good investment for you?
Well, the first deal in 2005 was actually a duplex. I'd bought some properties before, but it was properties that I lived in. But this was a pure investment play. And it was interesting because it was a property out right on the outskirts of San Antonio, and it was a single family cottage, and then it had a trailer, a 3-2 trailer that was in the same property. It was about an acre long, acre big property, so the numbers checked out. I mean, standard. You start looking at how much rents you can bring in. You make your deductions for expenses, and you calculate some other things that go into that to give you an idea of what your return should be. And so it all looked good, but like a lot of us, we have that first story where it's like, okay, well, that's not exactly what I had planned. But in this case, it's kind of one of those, like, you live and learn. But the property had a septic tank on it. And so we had a regular inspection done, but we didn't have a septic inspection done. Big no-no. And so about, I would say 3-4 months into ownership, we have a problem with the septic tank. Between the two properties, the people in the trailer actually brought in more than they should have been in that particular trailer size. They had some more people in it than there should. And the septic tank malfunctioned. It was already kind of full, and it just kind of malfunctioned. But come to find out that the actual municipality changed its rules, and I could no longer just fix the septic tank. I had to install a different septic tank, which is an aerobic tank, because it was kind of on a hilly area. And what that did is it eliminated the space that I needed to have the trailer. So it was one of those where it's like, oh my God, this is crazy. So we were able to negotiate somebody to take the trailer out. Unfortunately, you had to do that. And for part of what we did, the person who took the trailer out went ahead and paid for this aerobic tank. But in essence, so we kind of scratched there, getting rid of the trailer. But in essence, we lost income on that 3.2, which made the numbers not as good as they should have been. And in fact, for a lot of years, I kept that property for a while because it was a property that stayed full. It was never vacant. It was a pretty area, but the numbers never did quite catch up with my expenses based off of the loss of that one property. So I guess the lesson learned in all that, we made it work, and for tax purposes, it was good. And we actually sold that property. It's been maybe 3 years now since I sold it. So we kept it for quite a while. But the lesson learned is that, you have to make sure that you talk to others that are investing in those in the properties that you want. And in this case, we've been investing in properties in cities. This was the first time we kind of went outside a city and had to deal with a septic issue, and so that's a lesson. And the other lesson is obviously with only 2 properties there on any given point in time, if we would have had them both, when one drops out, you have 50% occupancy, right? That's kind of the other thing with smaller properties. When you get into multifamily, and this is kind of something that really kind of resounded to me later on, is like the more properties you have, the less you have to worry about vacancies of 1 or 2 or 3 units, because all the other ones still continue to pay in, which is a lot less risky, in my opinion.
Yeah. All right. So talking about, again, 2005, so you got the issue with the septic tank. So have you bought any other residential, properties until the 2016?
Yes, we bought, so I bought a couple of others. In fact, just before I started really focusing on multifamily, I bought a couple of properties. This was right after the recession of 2008. It was actually, I think, 2011 when I purchased. We were I was actually overseas in Mexico. That was my first experience buying a property while I was outside of the States. And so you kind of go through that process. And I still own those properties. They did work very well. Obviously, we bought right, and that's a key tenet. No matter what you're acquiring, you have to acquire right. And in this case, we did. We were able to acquire at very good prices, as a lot of people were still not, willing to invest in residential real estate. And my one regret, I guess, is not doing more of that, because those were fantastic deals. And we're not going to see those deals. I mean, even now, people are like, oh my God, we're in a recession and, prices are going to go down. Well, it's a whole different place. We have an excess in demand and not enough supply. And it's actually getting worse. So it's never going to be a place where you can just go somewhere and just pick a house and you're going to make money on it. You really got to do some analysis at this point. Make sure you're getting it right.
Got it. So my impression was exactly it, because I thought in my head it was like you're buy and hold investor, because you're just looking to buy the properties and keep them long term, right? Because most of the deals, like, you still have them, you carry through the deal with the septic tank issue, and you sold it like 3 years, from now, like, back. So that's pretty cool, because that's the way to grow your wealth at the same time, right? Slowly but surely, by holding on the properties. So,
that's correct. I would say the only difference is that there are different strategies that we use. Those syndications, for example, you don't buy and hold forever. You buy and you hold for about 5 to 7 years, depending on the asset. But ultimately, within those 7 years, you really squeeze a lot of the depreciation and the tax benefits out of that property. And then you basically move into a bigger asset. You can, or you can also refinance that asset and hold it for longer term. I would do that if it's a Class B asset, a newer asset, where you can just definitely hold on for longer. So yeah, buy and hold. It's kind of a notion of how long. I mean, it's not until they 40 years down the road. Although some people, there's some houses out there that owners have had forever. But in order to kind of squeeze the benefit on it, you really kind of have to do the work
Yeah.
and move on to something bigger. But it's not a fix and flip where you're buying and 6 months later you're getting rid of it, and you
Yeah.
got all
Yeah.
these other issues with taxes and capital gains and everything else.
Yeah.
Short-term capital gains anyway. Yeah.
Definitely. Yeah. So that's exactly what you mentioned. Like with the multifamily investing is a little bit different, holding period, 5, 7, depends on the strategy, and like underwriting, all of that. But again, can you talk about your transition going like, again, 2005, you started your journey in real estate, residential investing, and then you moved 2016 to commercial. So can you talk about your experience and that transition? Like, what did you do in that time to kind of educate yourself, and what type of resources have you consumed to, to put yourself in that position where you're able to invest in multifamily deals?
Great question. So yeah, I think really right around 2016, I was getting towards the tail end of my career, and I knew I wanted to make a change. I knew that single family was not going to be the way to do it. So I was kind of doing some digging, and I was talking to folks, and this whole notion of syndications came up. So it took me a while to kind of wrap my head around that. And certainly for, it's not a difficult concept. In fact, part of the book that I wrote is exactly to explain that, because it feels like it's difficult, but it really isn't. But once I kind of got my head around it, one thing I did want to do, and just based on my experiences, I wanted to ensure that I was, acquiring properties that met my criteria before I went out and I started looking and working with other people on properties that they were the main operator or the syndicator in, because I was still active duty. There was no way that I was going to be actively involved in a multifamily property. But what I could do, and this is something that is definitely a pathway, is I could invest passively in a real estate syndication. And believe me, and there were some jobs where, it was night and day. My last 2016, 17, I was working overseas. There was no way that I was going to be able to, to do a multifamily acquisition and be part of what's considered the general partnership where you're actively involved in that deal. There's just too many moving pieces. But it was great to be able to still get the returns on that passive investment. So that was kind of my mechanism. I figured, okay, I can't do active. I want to at some point, but in order to get there, I better understand it. As a passive investor, able to, work with those operators that I was investing with, and able to get some knowledge from them. And it isn't a lot. It's a lot of terminology, there's some different terminology, I guess I would say. But for the most part, the biggest concepts are the same. I guess one of the biggest differences, when you're doing single family, what matters the most is you're running comparables. You're looking at what other properties are worth, and what they sold for in that neighborhood where you're potentially going to acquire a new property. That's kind of how you gauge what it costs. Multifamily, the difference is how you value it, right? So in multifamily, you're taking that net operating income of that asset, and that's what's driving its price. So you could have, two properties next to each other. One is managed poorly, and it's making a lot less money. It's worth a lot less. It may even be a better property, but the fact that it's not giving the net operating income of the one next to it means that it's worth less. And so that's the key difference. But I like that, because you're able to, just kind of like in a fix and flip, you're able to make value where maybe it wasn't there before. And so that's kind of one of the biggest things you kind of get your head around, is how you value property, so you can do the underwriting and the analysis of these acquisitions. And so I had to learn the terminology. I had to learn how to underwrite multifamily properties. A little bit different, but if you know how to use Excel and you know how to do some basic math, you can get very good at just using those tools to give you the numbers that you need to be looking out for. Mm-hmm. And so passively investing, and then once I got out, then I was able to transition into a general partnership in multifamily.
Got it. So from those 10 deals that you have currently, how many of those deals are you involved as a GP?
3 at this point. 3. I'm actually working on my 4th one right now, so I'm happy about that.
Got it. So can you talk about the first deal as being a GP? What was that experience like? Because like stroking a check and, giving it to somebody that you trust with, it's a different thing. And again, the terminology, I heard people talk about that a lot, that they learn about the business insights, by being a limited partner at the same time. So that's a good way to go about. But what was your experience like being a general partner in the first deal?
Yeah, no, good. I mean, I think it was a great question. And I think what kind of set it apart for me is I knew I wanted to get there. And my mindset from the very get-go is, how do I get there? So when when I finally had the time, then I already had some notion and some level of connectivity of networking to be able to make that transition a little bit faster. And in fact, even before I was finally out of the military, they kind of give you about 6 months to kind of do all the things that you need to do before you retire. And so I took advantage of that time to really work the networks. And I was very forthcoming with people. I said, this is what I want to do. I mean, I've done some passive investments. I have a master's in business. I spent 28 years in the military. And so I have some value that I could add to your organization. And so, and oh, by the way, I have some money because I took some of the money from my single family assets and I turned those into, I sold those, and I had cash that I could bring into a deal. So it's one way to kind of walk into that general partnership potentially with a team that. So I worked with some people that, and I was very forthcoming about what I wanted to do. And I met them at a conference, and a couple of weeks, I'd say probably about a couple months later, I got a call say, hey, we have an opportunity. Are you interested? And so it was fantastic. So what I wanted to do and what I enjoy doing most for these, although I understand the underwriting aspect, what I wanted to do was be more on the front end, on the marketing side of things. I wanted to be the ones that assisted in raising that passive investor capital because I understand that. And I knew how it worked for me, and I can kind of translate that and use that to help raise that capital. And then just doing the investor relations all the way through the exit of that deal, whether it's 5 to 7 years, whatever that is, just maintaining that connectivity with the investors that I was able to help bring on board. And so that was kind of what I added in that deal, and that's kind of what I've been focusing on. And so I allow other people, and kind of the way I've structured my business is I work with other partners that are sourcing deals, that are working with brokers. And then I assist them, and I become part of their team, and I assist them in taking these acquisitions down.
Got it. All right. So talking about the investing criteria, I would like to ask a question. Again, having currently 3 deals as a GP and having the 4th one on the way, which I'm sure you're going to close, soon. Can you talk about the states that you're investing in currently and the states that you're looking forward to invest?
Yes. So I'm in Orlando, Florida. And not just because I'm here, but it also is Central Florida is a great market. There are some questions about, the effects of COVID, but you have to take these large MSAs, we call them, like, metropolitan areas, and you have to kind of come out in markets. So to make sure that you're really knowing and understanding what's happening, not just in the large MSA, but in these submarkets. And so there are pockets in Orlando, for example, that are still very good investment areas. There's high tech. There's, in fact, where I live, I'm closer to the Space Coast, where you have SpaceX and some of the other activity, than I am to downtown Orlando, and certainly the Disney parks, right? And so you just have to kind of break that down. I like Central Florida a lot. All the way, down to Tampa on the west, all the way to the East Coast, like I mentioned, to the Space Coast. And you have a large corridor there, and you have deep water ports on both sides of that. And so you have injects into Florida, and, up and down Florida, all the way up to the peninsula, not all the way down the peninsula, up to the, what I would call, Jacksonville and some of the Gulf Coast areas of Florida, that large rail movement from ships is getting property out to. And then, of course, you have Amazon and others that are doing the last mile stuff. So I really like that. I like the pro-business aspect of Florida. I like Texas. So just kind of shifting over. I like Texas. Texas recently, we signed the US-Mexico-Canada trade agreement. People sometimes forget that China is not our biggest trading partner. It's Mexico and Canada. Those are the two. They're the closest ones. So having that, they're coming in from Mexico into Texas, into the main lines of communication there. I love San Antonio. I love Houston. I'm looking into Dallas as well. Just great markets that are going to be that are being helped because not only are they pro-business, but you have a lot of trade that's coming through there that creates jobs and opportunities. So Texas is good. Atlanta is also good, just a big MSA as well. So there's a lot of activity, a lot of corporate headquarters in Atlanta. So those are some huge markets. And now I'm kind of dipping my toes in a little bit further into the Midwest. Nashville, outskirts of Nashville look good. Nashville kind of suffered with COVID, but what's happening with what COVID has kind of triggered is a lot of people that are kind of moving outside the core of these cities and wanting to go out a little bit further. They want more space. They want bigger properties. They may be working from home. They certainly don't want to be in these high rises. And so they're kind of moving out, and it's causing a lot of urban sprawl, suburbia, if you will, to kind of come back again, like it was in the past. And so we're trying to take advantage of some of those demographic changes. And Nashville is interesting because it's the largest metropolitan state area in a 5-state sort of geographic zone. So it's pretty huge. And so that's another market we're looking into heavy now.
Got it. So when it comes to the deals itself, can you talk about your underwriting process and what type of deals are you looking for in these markets?
Sure. I think right now a lot of us are kind of shying a little bit away from the more opportunistic type of investments and looking more at the very least solid C+ assets. And preferably B assets. And the reason for that is obviously COVID has really hurt a lot of the tourism industry. And what you have in the tourism industry is a lot of lower income workers that are suffering right now. And so certainly it makes it hard to, from a business when you have to really consider increased vacancies, that has to kind of factor in. So you can't raise revenue. You can't really do what we call value add, which is the multifamily equivalent of a fix and flip for single family. Can't really do that right now because you're not going to be able to raise rents. And so a lot of people are looking at properties that are at least stabilized and then shifting that value add into like year 2, year 3 and at that point, them looking potentially to drive up rents a little bit based on, being out of COVID and, potentially coming out of that recession. And one thing that we have to remember is that multifamily did well, even in the last recession where there was an excess of supply. And so we'll continue to see that, especially considering some of the scarcity as it relates to housing at this point. So we don't expect a huge drop off, but rents will be flat for a while, and it makes sense. I mean, obviously people are going to be struggling somewhat, and certainly more in that C class.
Okay, so talking about management, do you have your own in-house management team or do you hire a third-party management?
I do. So the way I structure my business, I kind of outsource just about everything. It's just a core function for me. And then I outsource using different methods. I use Upwork, I use Fiverr, depending. I have my own, my own bookkeeping and tax, consultants separate, but I keep it very small, because I want to keep it flexible. But there are ways to run this differently. And I recognize that some people inherently want to vertically integrate other things. You can grow your business. And then on top of that, you can create new businesses that support that existing, business. So for example, I know some folks that just vertically integrated into a property management company. So now they have the asset, they acquire the asset. So they do the asset management, and then they have a property management company that feeds in. And sometimes that gives you also additional scalability. But in my case, I'm strictly keeping myself kind of as small on purpose and looking for that flexibility that comes with being able to move with the market.
So when do you think it's a time, again, from maybe the conversations that you had with the people in your network before, when it's kind of like a good time or a strategy to have the in-house management team?
I think it depends on how fast you want to grow your business, and it depends on what you want to do in the long run. In my case, for example, I retired out of the military. I'm in my late 40s. I am not looking to grow an empire. So I'm looking to build generational wealth, and I'm doing it in a way that is incrementally done. If your goal is to grow, you're young and you can afford to, you don't have a family, for example, or you're you're still in that phase where you're kind of growing things, then you may want to look at some different alternatives where you start partnering with others, and you partner in a way where it's not just on deals, a little bit more transactional, but you actually partner and you create, larger entities so that you can then grow your business. So for example, some folks can easily take their, their business, this business, and then combine it with a larger capital company. And now you've got your acquisition, you've got a capital company that's focused and already has a lot of the money that you need to do some of these things. So it creates some synergy, and you can certainly grow faster. But the process is pretty much the same. So I don't know if that answers your question or not, but I think it's just a function of how you want, what your vision is for your company and what you want to do. But there are certainly ways to be in this business and grow it a lot faster. And there are ways that you can do it in a way that is a little bit more slower and a little bit less risky, if you will, because you're not growing that, that tail that comes along with a larger company.
Got it. Makes sense. So talking about building wealth, and at the same time, a lot of it is giving back, which is actually that's what you did with your book. That's on Amazon, Bluff. The bottom line up front. So can you talk about the book itself, what people should expect when they're gonna get the book?
Yeah, so I think that the whole notion of the book is basically a no nonsense. Here's what you need to know, how you go about investing passively, and it kind of talks to people that and to the right people, I think, because for example, military folks, we're moving around all the time, so you can't necessarily want to be the traditional landlord, because you may be in one place today, and next thing you got to go somewhere else for 6-7 months. So it kind of speaks to specific people, the busy professionals, the people that may be traveling, and it also talks to people that have been around and done the single family for a while. But the book is so the term bluff comes from, it's a military term. I know there's some other uses, but it's a military term that means that you're giving your boss a very fast summary, almost like an elevator speech, if you will, or elevator pitch before they go into doing whatever else they have that's very important. So we call it a bluff, and that's exactly what this is. There's not a lot of additional stories and a ton of examples. It's really a how-to, and from start to finish, and what that process looks like. And there could be more that go into that book for sure, but at that point, then it's not really. It's not meant as a bottom line in the front, and then becomes something else. Because that was my goal, is creating something that was readable, that was short enough, that people that really weren't looking to become long-term landlords or people that wanted to focus on potentially investing in real estate, but they didn't want to be real estate people, right? You got the other things that you got going on in your life. How can you do it? That was the point of it.
Makes sense. Great book, by the way. It sounds, and again, I'm happy that you cleared out the bluff meaning behind it. So now it makes more sense. Yeah, but that's great. So definitely we're gonna link the book in the description somewhere there, so you can find it and grab it on Amazon. Make sure you do that. The question again for you: $24 million AUM currently, and again have another deal kind of coming in right now. So what is your personal strategy, and what do you have currently going on in the pipeline? Are you planning to acquire more deals this year, and what do you think is going to happen next year for your own business?
Yeah, no, great questions. So when you go into a year, just like a lot of us, I had a plan of here's how I want to grow and here's how much what I want to do, and then of course COVID hit, and you kind of have to adjust. And we understand it. It's just like using another military analogy. You can have the best plan, but the minute you encounter the enemy, the plan's going to go to hell in a handbasket, and you got to go from there, right? But at least you have a plan. And so I had a plan that I wanted to grow to a certain level, but most importantly, and more importantly than the numbers, is really sustainability, right? So I had assets that I had to make sure that I had to focus on, along with my partners, to make sure that we took care of those and made sure that they kept providing the type of return investors. We held some of the returns for a little bit, just as a safeguard, We really didn't need to, but we, some of the distribution, we were very clear with our investors, like, we're going to hold this for a little bit just to make sure, because the most important thing to an investor is just you're safeguarding their capital. Yeah, it's great to make money. You want to make money, but more importantly, they want to make sure that at least they don't lose what they have. And so, that was key. So that kind of slowed things down a little bit. As far as what I'm looking at in the future is, it's become less about the numbers. It's more about making sure that any acquisitions that we make continue to perform, even in this environment. And so just a little bit slower. One thing I am doing a little bit differently, just as you're talking about different acquisitions. This latest acquisition is a build to rent property. It's a smaller property, but I like the thought of it, because when you think about property development is nothing more than a longer term value add. You're going from dirt to a finished product. There's value being created there. Just like if you take a property that's kind of broken down a bit and you fix it, you're creating value. So it actually works well in this environment, because there is sort of this idea that it makes sense to wait at least a few years before you start looking at ways to sort of increase rents and really drive things too far. I tell you that in the place that we're looking, I don't want to get too close because some of the regulations that I'm working with on the Rays here, but you have in the outskirts of it, in the main metropolitan area, you have a 34% tax increase because there just is not enough coming into the metropolitan area. So they had to raise property taxes. Those people are going to go somewhere. Yeah, because not only are people going to look to buy outside of that area just to avoid that property tax, but those owners, those landlords are going to have to pass on those costs as much as they can to the renters in those areas. And so we're sort of looking, and we're buying in places where we can continue to maintain rents lower because we're buying at the right price, that we don't have to worry about, some of the madness going on as far as some of the rates, as far as property taxes go. So it's a good proposition, because I think renters will appreciate the fact that, that it's brand new. They're larger units than we're used to. So these are 3, 2.5, or 2.5 with garage. So a little bit different than your typical multifamily, where you're looking at 2 1s, primarily, and then maybe some 2 2s and some 1 1s and 1 2s, and maybe a couple of 3 units in there and sprinkled in.
Before we connected, I seen you all over the place, doing multiple podcasts. So again, you're meeting all these great people, being on the shows, and you're talking about the business and, how you're going to develop it, how you're going to grow it, again, your passions. So, but what is the one thing that you want always people to remember about you?
The most important thing is that I'm doing this because I really love what I'm doing. I'm passionate about it. It doesn't feel like work, and I'm happy. And I'm sure there are a lot of people that will agree and will say, yes, that's true. Is that I'm happy to get on the phone with whomever and talk about this at no cost. It's like, and a lot of times they're like, listen, I gotta go, because I can just continue on talking about this topic, because I really do enjoy it. So I think that's the biggest thing. And wherever I can help, I really enjoy doing that as well. I think that's part of why, I joined the military in the first place. I felt like I could help that way. And certainly in the multifamily space, you're part of a team, which I also really enjoy. It's kind of very similar, not quite like being in the military, but there is still a lot of teamwork involved in taking down these properties. But more than anything else, I really enjoy it, and I'm happy to help.
Got it. And now I'm a little bit scared, because I might be sounding like those people that you said that they have to go, because we kind of have to go, because that was almost the last question that I had. But I kind of have the last question, for you is, again, I would love for people to get in contact with you, because again, you have a good spirit, which people can feel. And again, a lot of knowledge when it comes to real estate investing. And I think a lot of veterans who are watching this episode could take advantage of your experience and, your knowledge and insights, and, by just contact you personally. So I would love them to do that. So what will be kind of your main social platforms for people to come in and reach you out?
Yeah. So on my website, mirealestate.us, I have all of my platforms listed on there. You can also reach me through the website. And in fact, I'm for the first 5 people that reach out after they hear this podcast, communicate, send me an email or get a hold of me through one of my platforms that I'm a book. And then if it's, I'll send them a paperback if it's in the US. If it's outside the US, I'll send them an ebook. I don't know if there's some folks in Ireland that may be interested, but
Definitely. So,
definitely looking
so,
for that.
so for the next 4 people, because of course I'm going to be the first one, because that's before the show airs out. So hey, I have to take an advantage of it. So
Absolutely.
so that's awesome. I mean, a lot of great insights, information, and I just love the passion. And of course, there's a lot of behind the scenes, work that is involved into building this business. So you definitely should contact with Ismael and ask again those great questions, how they're involved in the real estate as a GP or LP or whatever that might be. So make sure to pass it along, this message, to a friend of yours who do you think will take advantage of this content, which I know he or she will. Again, a lot of great insights, great nuggets. So I really appreciate that time today, Ismael. Thank you.
Thank you. I appreciate it. Take care of yourself.
No problem. Thanks. And again, for you guys, I hope you enjoyed this episode. As I said, just share it with your friends. Make sure to contact with Ismael on social media channels that are linked down below. And as always, I'm going to see you in the next episode. Thanks.